EPK Capital presents Deep Dive Coca-Cola. Hello everyone, welcome to EPK Capital's Deep Dive video. I am your host, Sneha. In this series, we analyze one company each day based on the security analysis by Benjamin Graham. Today, we are going to talk about Coca-Cola. Today, Coca-Cola is more than just a beverage. It is a global economic institution. Its products are sold in over 200 countries and territories, with an estimated 2.1 billion servings enjoyed every single day. This unparalleled global reach has solidified its position as a cornerstone of defensive investment strategy. This analysis will provide a neutral, 360-degree examination of the Coca-Cola Company, traded on the New York Stock Exchange under the ticker symbol KO. We will peel back the layers of its iconic brand to scrutinize its financial health, its technical stock performance, and its valuation according to classic investment principles. Furthermore, we will weigh the compelling arguments for optimism against the significant challenges the company faces in the 21st century. The goal is to equip you with a comprehensive, data-driven understanding of one of the world's most recognizable companies. The anatomy of an empire: company, leadership, and ownership. From humble beginnings to a global behemoth. The story of Coca-Cola begins not in a boardroom, but in an Atlanta pharmacy in 1886. Dr. John Stith Pemberton, a pharmacist seeking to create a tonic for common ailments like headaches, developed a unique flavored syrup in a three-legged brass kettle in his backyard. His bookkeeper, Frank M. Robinson, suggested the name Coca-Cola, inspired by its two primary ingredients: extracts from the coca leaf and caffeine from the cola nut. Robinson, known for his excellent penmanship, also penned the distinctive Spencerian script that remains the company's logo to this day. However, Pemberton was more of an inventor than a businessman. The true architect of Coca-Cola's commercial empire was Asa Griggs Candler, an Atlanta businessman who acquired the formula and all rights to the business for a total of $2,300 by 1891. Candler incorporated the Coca-Cola Company in 1892 and deployed aggressive marketing tactics, including issuing coupons for free samples, which proved instrumental in building a loyal customer base. Perhaps the most pivotal moment in the company's history came in 1899. Three enterprising businessmen secured the exclusive rights to bottle and sell Coca-Cola from Candler for the astonishingly low price of just $1. This decision, while seemingly short-sighted, inadvertently created the company's immensely scalable and capital-light franchise business model. To this day, the Coca-Cola Company's core operation is not bottling, but the production of high-margin syrup concentrate, which it sells to a global network of independent bottling partners. This structure allows the parent company to focus on brand management and marketing, while its partners handle the capital-intensive work of manufacturing, packaging, and distribution. This business model is the fundamental source of the company's extraordinary profitability and enduring competitive advantage. The modern command structure and key influencers. Since becoming a publicly traded company in 1919, Coca-Cola's ownership has been widely distributed. Today, the company is led by Chairman and Chief Executive Officer James Quincy, who oversees a global strategy guided by a board of directors composed of leaders from various industries. In the context of a modern public company, the most significant promoters or influencers are its largest institutional shareholders. These massive financial institutions hold substantial sway over corporate governance and strategy. For Coca-Cola, the top institutional owners are a who's who of the investment world, consistently led by three giants. 1. Berkshire Hathaway Inc. Warren Buffett's legendary holding company is the single largest shareholder, a position it has maintained for decades. This is more than just a data point. It represents a multi-billion-dollar vote of confidence from one of history's most successful value investors in the durability of Coca-Cola's economic moat. 2. The Vanguard Group Inc., a leading manager of index funds and ETFs, Its large position reflects Coca-Cola's significant weighting in major market indices like the S&P 500. 3. BlackRock, Inc. The world's largest asset manager, its substantial holding further underscores Coca-Cola's status as a core holding in global investment portfolios. Analyzing the financial blueprint. A decade of performance, 2015-2024. A deep dive into Coca-Cola's financial statements over the past decade reveals a story of strategic transformation, enduring profitability, and shareholder-focused capital allocation. The story of revenue, refranchising, and pricing power. Observing Coca-Cola's revenue from 2015 to 2024, one might notice a dip in the years around 2016 to 2018, followed by a steady recovery and growth. A surface-level glance could interpret this as a period of weakness. However, this trend was the result of a deliberate and significant strategic pivot. During this time, the company accelerated its refranchising initiative, selling many of its company-owned, capital-intensive bottling operations to its network of independent partners. While this action reduced top-line revenue, it was designed to create a more agile, asset-light company with higher profit margins and a greater return on invested capital. The subsequent revenue growth, particularly in the post-2020 period, demonstrates the success of this strategy and highlights another of the company's core strengths: pricing power. In the face of global inflation, Coca-Cola has been able to consistently implement price increases across its portfolio without significantly damaging consumer demand, a testament to the strength of its brands. For the fiscal year 2024, annual revenue stood at $47.06 billion, a 2.86% increase from 2023. Profitability and margins, the power of the brand. The genius of the concentrate and franchise model is most evident in the company's profitability margins. Coca-Cola has consistently maintained a robust gross profit margin, typically hovering around 60%. This exceptionally high figure reflects the low cost of producing its proprietary syrups relative to the price at which it sells them to bottlers. Operating margins and net profit margins have also remained strong and stable, showcasing the company's operational efficiency and its ability to convert revenue into actual profit. Net income for fiscal year 2024 was reported at $10.63 billion, with diluted earnings per share, EPS, of $2.46. This consistency in profitability is a hallmark of a mature blue-chip company that can reliably generate earnings through various economic cycles. Balance sheet health. A look at debt. An analysis of Coca-Cola's balance sheet shows that the company carries a significant amount of debt. As of fiscal year 2024, its debt-to-equity ratio was approximately 1.69. While this level of leverage might be a concern for a less stable business, for Coca-Cola, it is considered manageable. The company's massive, predictable, and recurring cash flows provide more than enough coverage for its interest and principal payments, allowing it to use debt as an efficient tool for financing acquisitions and shareholder returns. Total assets for 2024 were over $100 billion, with shareholder equity at $26.37 billion. Cash flow, the engine of the dividend. The ultimate measure of a mature company's financial health is its ability to generate cash. Coca-Cola excels in this regard. Its cash flow from operations is consistently strong and predictable, providing the necessary capital to reinvest in the business, pursue strategic acquisitions, and, most importantly, reward shareholders. This reliable cash generation is the lifeblood that has enabled Coca-Cola to pay and increase its dividend for over 60 consecutive years, earning it the prestigious title of Dividend King and making it a staple for income-focused investors. A classic valuation applying the Benjamin Graham number. To assess whether Coca-Cola's stock is attractively priced from a deep value perspective, we can turn to the principles of Benjamin Graham, the father of value investing. The father of value investing. Graham's core philosophy was built on the concept of margin of safety, the principle of purchasing a security at a significant discount to its intrinsic value. This provides a buffer against errors in judgment and adverse market developments. Before proceeding, it is crucial to address a common misconception. Many online sources promote a formula known as the Benjamin Graham formula for growth stocks, V-ACE FSX 8.5 Pub/Slice 2G. Graham himself never recommended this formula for valuation. He mentioned it only once, in a chapter unrelated to stock selection, to demonstrate how the market's growth expectations are often irrational and unjustified. Using this formula for active valuation is a misapplication of his teachings. The verdict, according to Graham. With a current stock price hovering around $70, the calculated Graham number of approximately $19.71 suggests that, according to this highly conservative metric, Coca-Cola stock is significantly overvalued. However, this result comes with a critical caveat. The Graham number heavily weights tangible assets, the book value, on a company's balance sheet. For a company like Coca-Cola, its most valuable asset is not its factories or equipment, but its intangible brand equity, which is not fully captured on the balance sheet. The vast difference between the Graham number and the market price is, in effect, the premium that investors are willing to pay for Coca-Cola's world-renowned brand, its global distribution network, and its consistent earning power, all factors that this specific formula is not designed to measure. The investor's dilemma: the bull case versus the bear case. Investing in Coca-Cola today presents a classic dilemma with compelling arguments on both sides. The bull thesis: why investors are optimistic. The case for investing in Coca-Cola rests on its formidable and enduring competitive advantages, often referred to as its economic moat, unrivaled brand and pricing power. Coca-Cola possesses one of the most recognized and valuable brands in the world. This powerful brand loyalty translates directly into pricing power, the ability to raise prices to offset inflation and protect profit margins without losing a significant number of customers. This is a crucial advantage in any economic climate. Global distribution network. The company's franchised bottling system is a logistical masterpiece, giving it unparalleled reach into the most remote corners of its 200-plus country market. This distribution network is a massive barrier to entry that is nearly impossible for competitors to replicate on a global scale. Successful diversification. While synonymous with its flagship cola, the company has strategically diversified its portfolio to align with changing consumer tastes. It now owns over 200 brands, including 21 that generate over $1 billion in annual sales across high-growth categories like bottled water, Dasani, Smart Water, sports drinks, Powerade, juices, Minute Maid, and coffee, Costa Coffee. This diversification mitigates its historical over-reliance on carbonated soft drinks. A fortress for income investors. As a dividend king, with over 6 decades of consecutive dividend increases, Coca-Cola is a cornerstone for investors seeking reliable, growing income. Its defensive nature and stable cash flows make it an attractive holding during times of market volatility. The bear thesis: why investors are cautious. Despite its strengths, Coca-Cola faces significant and undeniable headwinds that form the basis of the bear case. The secular decline of sugary drinks. The most significant threat is the long-term global shift in consumer preferences away from sugary beverages. Growing health consciousness regarding obesity, diabetes, and other diet-related illnesses directly targets Coca-Cola's core product category. This is not a cyclical trend, but a fundamental, secular shift in consumer behavior. Regulatory and tax risks. Governments worldwide are increasingly implementing soda taxes and other regulations designed to curb sugar consumption. The expansion of these policies could directly compress Coca-Cola's sales volumes and profitability. Intense competition. The beverage market is fiercely competitive. Coca-Cola not only battles its traditional rival, PepsiCo, but also faces a growing threat from a vast array of smaller, more agile brands that are often perceived as healthier or more authentic. ESG and reputational risks. The company is under intense scrutiny for its environmental and social practices. As will be detailed next, major controversies related to plastic pollution, water scarcity, and labor practices pose significant reputational and regulatory risks that could lead to consumer boycotts and stricter, more costly operating requirements. The central tension for any potential investor is whether Coca-Cola's efforts to pivot toward healthier beverages can outpace the decline of its legacy soda business. An investment in the company today is a bet on its ability to successfully manage this critical transition. Essential due diligence, controversies, and global footprint. No analysis is complete without examining a company's environmental, social, and governance (ESG) record and understanding its global operational footprint. These factors are intrinsically linked. The company's massive scale is both its greatest strength and the source of its most significant challenges. A history of controversy. Coca-Cola has faced numerous high-profile controversies that represent material risks for investors. Water usage and pollution. The company's operations require vast amounts of water, leading to intense conflicts in water-scarce regions. The most well-documented cases occurred in India, particularly in Plachimada, Kerala, where bottling plants were accused of depleting and contaminating local groundwater sources, severely impacting local farmers. These disputes led to widespread protests, legal battles, and the eventual closure of a plant. Plastic pollution. For several consecutive years, audits by environmental groups have named Coca-Cola the world's #1 plastic polluter. With its massive production volume, the company's plastic packaging is a significant contributor to global waste, creating a major reputational and regulatory challenge as governments and consumers demand more sustainable solutions. Labor and human rights. The company has faced serious allegations regarding its labor practices. In Colombia, Coca-Cola's bottling partners were sued and accused of using paramilitary groups to intimidate, torture, and even murder union leaders. In the United States, the company settled a landmark racial discrimination lawsuit in 2000 for $192.5 million, the largest of its kind at the time, over allegations that it limited the pay and advancement of its African American employees. Marketing blunders. The most famous marketing misstep in corporate history was the 1985 launch of New Coke. The company changed its 99-year-old formula, sparking a massive consumer backlash that forced it to reintroduce the original as Coca-Cola Classic just 79 days later. The episode became a textbook case study on the power of brand loyalty and the emotional connection consumers have with a product. Global market position, where the revenue flows. From Coca-Cola's dominance is global, but its financial performance is not uniform across all regions. The company possesses a staggering 42% market share in the global non-alcoholic beverage industry. This data clearly illustrates that North America remains the company's most important market, contributing the largest share of both revenue and operating income. While mature, it is the financial engine of the company. In contrast, regions like Latin America and Asia Pacific represent key areas for future growth, though they currently contribute a smaller portion to the overall financial picture. Conclusion: a refreshing summary, synthesizing the analysis. The Coca-Cola Company stands as a titan of industry, a financial fortress built on one of the world's most powerful brands and an unrivaled global distribution network. For decades, it has rewarded patient, long-term investors with steady growth and a reliably increasing dividend, cementing its status as a classic defensive, blue-chip stock. Its strategic shift to an asset-light model has fortified its already impressive profitability, and its ongoing diversification into healthier beverage categories shows a clear awareness of the challenges ahead. However, an investment in Coca-Cola today is not without significant considerations. The company's legacy is inextricably tied to a product category, sugary soft drinks, that is facing a secular decline driven by global health trends. This creates a fundamental tension that the company must navigate. Furthermore, its massive operational scale has given rise to serious and persistent ESG challenges, from being the world's top plastic polluter to facing controversies over water rights and labor practices. From a pure valuation standpoint, traditional metrics like the Benjamin Graham number suggest the stock is priced at a significant premium, a premium the market is willing to pay for its intangible brand equity, but one that offers little margin of safety for value-conscious investors. Ultimately, an investment in KO is a bet that this century-old giant can leverage the immense cash flows from its legacy business to successfully pivot and dominate the beverage categories of the future, all while managing the complex reputational and regulatory risks that come with being a global icon. Final disclaimer. The information provided in this video is for educational and informational purposes only. It is not intended to be and should not be construed as investment advice. We are not financial advisors. Investing in stocks involves risk, including the potential loss of principal. You should always conduct your own thorough research and consult with a licensed financial advisor before making any investment decisions. The creators of this content will not be held liable for any losses or damages resulting from the use of this information. And that's all we had for this video. We hope this video was informative for you. If you think it was, then please do like and share this video. Also, do not forget to subscribe to our channel for such wonderful daily content. You can also follow us on Instagram and Twitter. The details are in the description. Just a quick reminder that this video is for educational purpose only and should not be taken as financial advice. For your personal financial advice, kindly get in touch with us on details in description, or you can connect with your financial advisor.